Your mom who still asked you if you and Thingy are serious. Thingy being Don, your husband. Yes, she still makes you have those annoying relationship chats. But good news, she's family, which means together you can save. PPS Investments Family Network. The more you and your family invest together, the more everyone saves. So, start building your intergenerational wealth today. Contact your accredited PPS advisor or visit pps.co.za. PPS Investments Pty Limited is an authorized licensed financial services provider.
The Money Show.
Personal Finance with Warren Ingram.
Personal Finance with Warren Ingram, brought to you by Vodacom Business. Turn your dreams into growing business. Search Vodacom Business SME. Warren Ingram, The Money Show on a Thursday night. Are you switching yourself poor? What is switching?
Switching is when we start, let's say we start the year and we've got a unit trust that invests in shares. And somewhere in that year, we become a bit afraid about the state of the world or about stock markets. And we decide to move the money from our share-based unit trust, let's say, to a money market unit trust, which is kind of the typical thing that a lot of investors would do. So that transfer from the share-based unit trust to the money market unit trust, that's called a switch.
Okay. Is it an expensive thing to do? Why are we struggling with the Zoom calls all of a sudden? Zoom's been great for the better part of a year. And suddenly, and then we lose Warren. Producers, are we phoning Warren on the old-fashioned cellular telephonic device? Because what we did see last year was an awful lot of switching. We saw markets collapse and people panic. And people taking money out of shares and putting them into other kinds of funds. And I think that's where it costs the money. I don't think the switching itself costs an awful lot of money. There we go. Warren, I'm sort of half hearing you on the Zoom call. Do you want to get rid of the Zoom call and maybe get on the phone? And then we'll put you on the phone in just a moment. Warren Ingram, he's an executive director at Galileo Capital. He's a personal financial advisor. And a lot of people switch and get burned.
Are we okay?
We're okay, I think. Okay, we weren't okay.
Sorry about that.
That's all right. But we're back. Talk to me about switching. So the act is switching. So if I switch from a general equity unit trust into a money market fund, that's not what is expensive. It's an inexpensive transaction to do that. You're talking about the opportunity cost, I think.
Yeah, in other words, your investment, and let's stay with the share one because it's so relevant now in the last 12 months. So the opportunity cost, in other words, you moved from the share-based unit trust to the money market unit trust. Over the last year, you would have been really lucky if your money market unit trust had given you about 5% growth from February last year to February this year, whereas your share-based unit trust probably gave you around 30 or so percent. And so that difference is the opportunity cost that we're talking about. And it's something that repeats itself all around the world, time and time again. In really tough market conditions, already when the markets have dropped, that seems to be the time when people make the most switches. And I don't want to point fingers just at investors. I mean, this is across the board. This is pension funds, it's balanced fund managers, it's investment advisors telling their clients to do it, and then it's the direct investor themselves. All of them seem to do it at the same time. And unfortunately, they tend to do it at the worst possible moment. It's usually the month where the market absolutely bottoms and then starts to turn. And that's the really frightening thing in a situation like this, is we somehow have this kind of, as a collective, the worst instincts as investors, and it really costs us money.
And so this time last year, a little bit after this time last year, it was late March, early April, as markets were falling, I re-listened to an interview I did with you back then, nearly a year ago, can't believe it. And you were telling us back then, stop panicking, don't sell your investments. I mean, there's a huge amount of pressure on investors, for example, to switch not only out of their share portfolios, but to switch out of South Africa altogether, as the rand was sliding towards 19 and hit 19 to the US dollar, as the stock market fell all the way down to 37,000. There was just this cacophony saying it's all over. It's all over. The Titanic has hit the iceberg. It is taking on water. It is going to tip up. It is going to break in half, and everybody is going to drown, and those who don't drown are going to freeze to death. And there was panic. There was pandemonium. And you were saying, stop listening to the nonsense. Unfortunately, lots of people did. The guys at Momentum have actually got some data on this, haven't they?
Yeah, and I don't, me, I don't often talk about product providers and the like, but this is a behavioral finance team at Momentum headed up by Paul Nixon. And what's so exciting for me, I know it's probably a lame thing to be excited about, but we're getting, almost live research of real investor behavior in South Africa. And what they found was, in the month of March last year, really at the bottom of the markets, investors switched about 300% more, so 3 times more than they would switch in a normal month. And so that's already one big factor. So at the worst possible moment, people are making radical decisions in really fearful times. And the average value of the switch that was in this pool was around 150,000 Rand. And then this behavioral finance team looked at what actually happened to the fund that the investors went into. So the switch, what did that fund do over the subsequent time? And what did the fund do that they should have been in, the one that they were in originally and that they switched out of? And what they find is that investors are about 29,000 Rand poorer because they made a switch. So out of their 150,000 Rand, if they had done absolutely nothing, if they'd kept listening to the show and just stayed the course, they would be nearly 30,000 Rand better off now than they actually are. And that's over a short period of time. That's it's literally a year. And if you just think about that, it's a 20% difference in 1 year. It doesn't take long for you to actually keep doing that and switching your money to the point where you've got almost nothing left. And that's really our core message here.
No, absolutely. I mean, and for some people, this will be the barn door being closed long after the horse has bolted, because people are scared. I mean, people get very, very frightened. There is this sense of Armageddon, and there's a huge role that is played by advisors here when it comes to this sort of activity. No advisor wants to say to their client, just leave your money where it is and it'll be fine, because 3 months later it's not fine, and they get shouted at, and then they get fired, and money is a deeply personal thing. So people make bad decisions in difficult times, and it's just sticking to your knitting so often can actually save you an absolute fortune.
I think sometimes when you're looking at investments, whether you're the advisor or the investor, you need to think a bit like the guys who design Porsche 911s. The car really, if you look at it, 30 years ago and you look at it today, it's not super different. And the ignorant person would accuse them of being lazy, whereas the experts might say, well, they came up with a pretty good structure and a pretty good design 30 years ago. What they've done is they've tweaked it and improved it gradually in very small bits from 1 year to the next. So they're improving on something which was already fundamentally really good. And that would be my comment to people in a situation like this: is if your investments were well structured going into a major big surprise event. I mean, COVID was completely unpredictable. Then the point is you got to start thinking like that Porsche designer to say the design was good when we went in. We were built for potential market crashes that we didn't know would happen, and now we're in it. Let's trust the design. Let's be like the Porsche designers. Expect the car to get through the rocky times on the other side. And once we're through it all, maybe we can learn a lesson or two and tweak the wing mirror or the spoiler a little bit or whatever the deal is, but we don't need to change the whole car completely. And it's exactly the same with investments. You don't need to throw out the whole design. If it was a good design in the beginning, why is it a bad design? Simply because markets fell apart.
Good point. Thank you, Warren Ingram. In a moment, Roland, who sent me an email, needs an answer, please. Roland's question was, I have been retrenched as a security officer for 3 years, and I will be receiving my Provident Fund money, and I want to invest it by buying shares or any other investment. But I don't know where to start. I can't think of a better place to start than asking that question, which I will put to Warren in a minute or two.
The Money Show.
Personal Finance with Warren Ingram.
So, retrenched security officer Roland has got his money after 3 years, Provident Fund money. It takes a long time. He wants to invest it in something. How does Roland go about this, Warren?
So just reading his mail, I'm not sure whether he's been working for 3 years and now he has, he's going to get his Provident Fund payout. And so if that's the case, then my first piece of advice, Roland, is please don't cash in your Provident Fund. It's something that a lot of people do where they take their Provident Fund money. And let's just say we don't know the numbers at all, so I'm just really thumb sucking now, but let's just say it's 100,000 Rand. And then they say, no, I want the money as cash. I don't want to leave it in a retirement fund anymore. What then happens is SARS takes a healthy chunk of that money, and it could be anything from around 30,000 Rand right up to 45,000 Rand of that money that just disappears. That's just tax that's gone. And then Roland has the balance to then try and start an investment portfolio. And the first thing he has to do is he has to make up that lost tax that he's just paid and then get ahead. And to me, that's a really tragic decision. So the first thing I want to say is, if you're still in a Provident Fund, you can move it to a preservation fund. That simply means that it goes from being a retirement fund at your employer to a retirement fund in your own name. Most unit trust companies and insurance companies offer them. And then you can choose a unit trust, for example, that's, let's say, a balanced unit trust that has a very high exposure to shares. And that would be the simplest way of doing this, where you get exposure to shares without paying the tax. And then you defer the tax to one day when you're retired. Much better idea. If Roland's already taken the cash, in other words, he's paid all the tax and it's now cash that's sitting in his bank account, then my suggestion is to look at a really simple way of buying shares, very cost effective, and that would be what they call an exchange traded fund. So what it does, it will track the top 40 shares on the South African stock market, and there are lots of those nowadays. But if you just choose, an exchange traded fund that's called the top 40, top 40 tracker, then you can. To me, that's a good way of doing it. And a place like Easy Equities, they've got options like that where you can choose a top 40 index. I would rather do that, for example, than try and choose, 1 or 5 shares that you believe are going to outperform, because your chances of making a mistake are much higher than just choosing a top 40 index where you've got 40 different companies that will hopefully mostly perform well, even if a few don't. And to me, that would be my short answer to Roland in this situation.
Okay. Roland, thank you. I mean, I would give you a far simpler answer than Warren. So you ready, Warren? You go onto takealot.com. You can download an ebook or you can order the physical book. It depends. You sound young and funky, so maybe you want an ebook for 185 Rand. It's called How to Make Your First Million. It's by the author of Become Your Own Financial Advisor. It's by a guy called Warren Ingram, and he goes into a lot of detail. It's still my go-to book in terms of the basics of investing. I recommend you take 185 of those rents that you have got from your retirement savings and your Provident Fund money, and make that small investment, and you will save an awful lot of money over the longer term. I've asked you to have a look at a phrase for the week. The thing's called transfer penalties. Now, this is different from a switching cost. A transfer penalty is something fundamentally different, right?
It is, and it's one of my biggest bugbears in the investment industry in South Africa. So typically, what happens is, let's say you bought a retirement annuity a few years ago from an insurance company, and let's say you're 30 years old, and after 5 years, at age 35, you decide, well, I actually don't like the performance of this retirement annuity anymore. I'd like to move it to another retirement annuity. So you're not cashing it in. You're not trying to just switch a portfolio. You literally want to move it from company A to company B. The law in South Africa allows insurance companies, and it is really the insurance companies, to charge you a penalty, and it can be as high as 25% of the value of your money. So if you've got 100,000 Rand in there, it can charge you 25,000 Rand as a penalty for you to move that money from company A to company B. And just to emphasize, that's your money. They're charging a penalty on it. So they're taking away your money because they're saying these are fees we would have earned for the next 25 years. You're leaving. We did a great job for you in the first 5 years of your investment's life, and we deserve to get the 25 or 30 years worth of fees all at once. So if you leave, we're taking our fees, and good luck to you. And that's in the real essence what a transfer penalty is. And it's completely legal. It's been around since Trevor Manuel's time when he fought this issue and got the penalty to be reduced because, believe it or not, it was higher. But that's really the deal. So if someone's got a retirement,
how does something as antiquated as this survive? I mean, we've only got 90 seconds, but it's just the most bizarre, really antiquated cash gouging mechanism.
The answer I've heard in the past is that it was a mechanism for people who are only able to invest, let's say 100 or 200 Rand a month, to get advice from a highly qualified insurance agent who needed to be paid properly for giving that advice. So the way that they justified this was that the smaller investor with a small amount of money would be sold something that would cost a small amount of money over a long period of time, because they were then given this long contract. And so it was a fair exchange according to the insurance industry. I obviously think that's nonsense. I mean, I think unit trust companies don't charge these fees if you move your RA from one unit trust company to another.
So this is important. So if you've got your unit trust with, say, your unit trust RA with one unit trust company, and you're advised to move it onto somebody else's platform because you're told that the platform will give you more diversity, you don't get paid, you don't get charged nearly the same amount of money, do you?
Exactly. You actually get charged nothing. Unit trust company RAs, they charge you a pay-as-you-go fee. So it's literally every month that you're there, they'll charge you a fee. If you transfer, there'll be an admin issue, just literally the process of transferring from one to the other, but no penalties, no costs, none of this nonsense. And that's really the way the industry should be.
I think somebody's ripping the ring out of us. I really do. Thank you, Warren Ingram from Galileo Capital. He's a personal financial advisor. He is a director at Galileo Capital. Every Thursday night, taking us through issues around personal finance. You can get our show details on the radio station website. Send us emails, questions that we can put to Warren on your behalf, and he will answer them because he's that kind of guy.